Hey fellow traders, welcome back to the channel. In today's video, I want to show you how do you use multiple time frame analysis to catch big trades. This video will show you how to catch big trades that yield big profits. We are not interested in trades which you put in $1 and you make back 50 cents, you put in $1, you make back 150. Okay, in this video, we're interested in trades which you put in $1, you get $3. And basically high reward to risk trades. And I want to show you how do you do that in today's video. Okay, so what will you learn in today's video? I want to start off by explaining to you why you should be using multiple time frame analysis in case you are not using it already. It's very important that you integrate multiple time frame analysis into your trading, and I want to convince you as to why you should be doing this. Then I want to show you how do you select your time frame combination using the factor of 4. Then I want to go on to the swing trading strategy that was taught previously. Okay, just in case you didn't watch it, that video, I will leave a link at the top right hand corner. But I want to do a brief introduction to that trading strategy again, because I want to incorporate multiple time frame analysis into this swing trading strategy. So I want to make this more advanced. I want to combine multiple time frame analysis and swing trading strategy to help you find trades which can yield very good reward to risk ratio. Then I will end off this video by showing you an exact case study. In fact, this case study will be a trade that we send to our premium subscribers today. And that trade is pound dollar, okay? We're going to break down step by step why did our team decide to take this trade, the thought process, everything, all those good stuff. Okay, so let's move on. So why use multiple time frames? Why should you even look at multiple time frames? It's confusing, it's harder to trade. Yes, that is true. But when you're using multiple time frames, what happens is that you actually get higher probability trades. Just think of it, which has higher probability? 3 time frames pointing to a bearish move, or let's say just 1 time frame pointing to a bearish move? I think it's a no-brainer, right? It should be the former. It should be 3 time frames. So if let's say you have the daily chart saying that it's bearish, you have the H4 chart saying that it's bearish, and you have the H1 chart saying that it's bearish. So something like this, okay, you have the daily, you have the H4, and you have the H1, okay? So if let's say this is bearish, and this is bearish, and this is bearish, where do you think price is likely to go? Which do you think is it's higher probability? This scenario 1 or scenario 2, where maybe your daily chart it's in down, okay, your H4 is up, and then let me just draw it, and then your H1 is down, okay? So which do you think has higher probability? It should be the first case, first scenario. So that's why you want to use multiple time frame analysis. You want to align the multiple time frames together. When it says that the market is bearish on all 3 time frames or on 2 time frames, whichever time frame combination you choose, then that's where you get your highest probability trade setups. Another reason why you want to use multiple time frame is because it allows you to catch big reward to risk trade. Okay, because you can fine tune your entry. That means that you can enter on a lower time frame where your stop loss is tighter. Let's say you are trading the daily chart. Okay, so daily chart, the range tends to be very wide. So if you actually drill down to the H4, what happens is that you can have a tighter stop loss. If your entry is based on the H4 chart, then you can have a tighter stop loss, and if price were to move in your direction, then you will be able to capture a better reward to risk trade. So let's move on. Now that you are convinced, I hope you are convinced. Let me just clear this up first. Then we'll move on. Okay, so I want to go on to how do you select your time frame, because you are convinced you want to use multiple time frame analysis, and that's why you're watching this video. Okay, so how do you do it? I want to introduce you the concept called the factor of 4, or personally what I call the factor of 4. So whichever time frame combinations you choose, you want to make sure that it is at least a multiple of 4. Okay, so what do I mean by this? Very simple. Let's say you are doing the monthly, weekly, daily combination. You can see that monthly is actually about 4 weeks. Weekly to daily is about 5. It's about a factor of 5 because in a week there's 5 days. In a month there are at least 4 weeks, depending on the month, of course, but you have at least 4. So you want to apply this factor of 4. So in the second combination over here, it's the same. Okay, this one over here, daily H4, H1. In a day, there are 6 H4 candles because 6 times 4 is 24, and there are 24 hours in a day. So that part, it's fits the multiple of 4. H4 to H1 is of course a multiple of 4 as well, because 4 H1 candles make a H4 candle. So that is the other combination, or you can even use this one over here, which is H4, H1, M15. Same thing again, it follows the rule of factor of 4. So H4 to H1, it's a multiple of 4. H1 to M15 is again a multiple of 4. So you just want to follow this rule. I do not want to go into the full details about why you should be using a factor of 4, but just take it from me that you want to at least be using a factor of 4, okay? You do not want to be using things like this, okay? Maybe you can try understanding why this is not a good combination. Why is this not a good time frame combination? You might want to pause this video and consider. But the answer is actually real simple. H4 to H1 is a multiple of 4, that's right. But H1 to M30 is only a multiple of 2. It's not a multiple of 4. Because in an hour, there's only 60 minutes, and M30, it's one candle is 30 minutes. So two 30 minutes candle make up a hourly candle. So it is not a multiple of 4. So you do not want to use this time frame combination. So this is how you use the factor of 4. Just just to clarify, you do not need to choose 3 time frames, but you do need to follow the factor of 4. You could just trade the daily and H4, that's fine. You could just trade the H4 and H1, it's fine. But you want to stick to the multiple of 4. So hopefully that is clear. If something is not clear, just leave a comment down below. My team will do our best to help you and assist you with any questions you have. Now I'd like to do a brief introduction of the swing trading strategy that we covered many times. In fact, we have a lot of videos about this strategy. We show you that this strategy is really powerful, it works. But just in case you have not watched that, I want to just do a brief breakdown, because after that, I want to actually apply this strategy with the multiple time frame analysis. So step number 1, it's to draw a trend line. Okay, so what I'll do is I will go to the charts after this to show you this strategy first before implementing the multiple time frame analysis. Okay, so step number 1 is you draw trend line. You are looking for either a trend line break or a trend line bounce. Then you want to draw your Fibonacci retracement tool and watch the 0.618 or 0.786 Fibonacci level. Okay, apologies for this. This one over here should be a dot instead. Okay. Then you want to look for market structure confluence, and then you want to enter when you see a trigger at the level. Okay, so that's step by step. Now let's go into the charts, and I want to show you how do we do this swing trading strategy without multiple time frame analysis first. Then after that, I will show you how do we apply multiple time frame analysis into the strategy. So very simple. Very simple. The first step that you do is you always draw your trend line first. Okay, so let me just see if I can find a good example over here. Okay, we do have an example over here. Okay, so over here we have a downtrend, and step number 1 involves drawing a trend line. So you can see that I've connected this swing high here and this swing high here. So what is next? That's step number 1. Step number 2 is you draw a Fibonacci retracement. So I'm going to draw high to low because I'm trying to project resistance. Okay, I have another video about how to draw Fibonacci retracement. In this video, I'm going to assume that you already know how to do it. But if you do not know how to do it, then check out my other video about Fibonacci retracement, because that's the complete guide. I think it's called the ultimate guide to Fibonacci retracement. So just check that out. Okay, so this is step number 2. You draw the Fibonacci retracement. Step number 3 is you look for market structure at this level, which is the 0.618 level and the 0.786 level. So let me just mark this out. This is the 0.618 level, which is also known as the golden ratio, and then the 0.786 level. So somewhere here. So if you look left, you do see some form of market structure over here. You can see that if you were to switch to the line chart, you can see that there is this swing low over here, something like this. So you can reasonably conclude that there is some form of resistance over here. Okay. If you want to be really precise, what you can do is you can use the you can draw a horizontal line to this level. In fact, this level is a good level because if you look back into history, you can see that this level was also supported. So if you change back to the candlestick, your entry would have been somewhere over here. Okay, so that's how you do it. You draw a trend line, then you draw your Fibonacci retracement tool. You look for the 0.618 level or the 0.786 level. Then the last step is you look at the market structure to confirm that the level that you are looking at is a very strong level. So in this case, we have the confluence of the trend line. The trend line is saying that there's resistance here. Then you have the confluence of the Fibonacci level, which is the 0.618/0.786 level. And you also have market structure. So that's how you do it. That is how you apply this swing trading strategy. So hopefully you understand this. If not, just watch the other video about how to swing trade, because that video we really break down. We give you a lot of examples. But this video, we just want to show you how to do multiple time frame analysis. So I won't spend too much time on this portion. Now, by the way, we have a 3-day trading guide for you over here. So you can see that it's very nicely done. We teach you how to read market conditions. How do you read candlestick patterns? We have a candlestick pattern cheat sheet for you as well. So if you have not gotten this, the link is in the description. Make sure you download it. Okay, it's totally free. There's no catch. At the same time, please give us a thumbs up because we are trying to reach more traders. So, with your help, you are going to boost the YouTube algorithm and we're going to reach more traders, right? Make sure you subscribe also because we create a lot of videos like this to help you become a better trader. Okay, hopefully you can also see that we are really committed to serving you at the highest level possible. We don't just create videos once every month. We create videos like this every day, and we are answering your questions every single day. If you have any questions, just feel free to leave a comment down below. Feel free to reach out to us. We love to help. Okay, we are really serious about what we do over here. We want to give back to the society because we know how hard it is as a beginner trader without much capital. You don't have money to invest in education, and educational courses are expensive. And that's why we create this value. We create this value to serve you so that you do not need to pay thousands of dollars to learn what we learn. So hopefully this kind of videos is helpful for you and you found some value from our videos. Okay, so let's move on. Let me just change over back to the slides and let's look at how do you actually implement multiple time frame analysis into this swing trading strategy. The answer is actually very simple. It's the same exact steps, except that we are going to implement this over here. Okay, we're going to implement this over here. We're going to implement the higher time frame key levels. We want to identify the key levels and we want to go into lower time frame to enter the trade. When we do this, we are able to have a bigger reward to risk ratio because you are entering off a higher time frame levels. And as a general rule of thumb, the higher the time frame, the bigger the movement. Because a candle on a weekly chart, the range of a weekly candle is definitely bigger than the range of a H1 candle or H4 candle. So if you can find a weekly level and you can find a H4 entry into your weekly level, that's how you actually find big reward to risk trades. So I want to show you how to do that. So the other 3 steps are the same. It's the same as this over here. So I will not repeat it. But what I'll do right now is I'll go onto the charts and show you step by step how do we do this. So let's go back to euro dollar. Sorry, not euro dollar, pound dollar. And let's look at the market condition right now. Okay, so step number 1 is you always go to the higher time frame. So ask yourself, where is price at now? Okay, so it's very simple. Right now, price is actually a resistance. You can see that this is the prior resistance. Okay, if you cannot see this, just change to the line chart. Then you can see that this is the level that the market is looking at. So that is your level. So this is the higher time frame level. Next, you want to go into the lower time frame. Remember what I said about the factor of 4, 1:4. So your next time frame, if you want to drill down, if you want to trade the lower time frame, you need to be looking at the H4, the 4-hour chart. So in this case, I'll look at the 4-hour chart and I will find my trend line. Remember, we are looking for either a trend line break or a trend line bounce. So in this case, we have something like this. This one over here, if you were to draw this trend line here. Again, I have another video about trend lines, how do you draw trend lines. So if you know you are totally new, you do not know how to draw trend lines, check out my other video. We really have a lot of materials for you. Everything is being covered. So if you do not understand a certain concept in this particular video, right, just make sure to check out the other videos because we really provided you everything we can, everything step by step. We cover everything. So really, there's really no reason why you cannot learn what you need to learn from our channel. So over here, you can see that I connected this swing low with this swing low, and you can see that this is the trend line break. Trend line broke, retested. So that is the step number 1. You are looking for a trend line break or trend line bounce. So in this case, it's a trend line break and you are retesting the trend line. Step number 2 is you want to draw a Fibonacci. So you take from high to low. Again, if you are trying to find resistance, you draw it from the high to low. Then you are looking at this level, which it's the 0.618 level and the 0.786 level. So let me just draw it over here. And you can see that this level, the confluence, lines in nicely with the higher time frame resistance. This is your higher time frame resistance. Let me just change the color so that it's clearer. So the black line is actually the higher time frame resistance level, which was identified in the day chart. So that's the power of using the higher time frame. You do that, so you get 1.3128 as your resistance. You go into the H4, you find that a trend line has been broken. What do? You draw a Fibonacci retracement, and then you see that there is confluence between the higher time frame level over here. Then you see that there's a confluence between the trend line, the broken trend line we tested. You see that there's confluence with the 0.618. You see that there is some form of market structure as well. If you look to the left over here, this looks like a head and shoulder. This is the left shoulder. This is the head, and this is a potential right shoulder. So you can see that there are many factors. There are many confluence aligning with this trade, and that is why this is a good trade. That is why you can enter somewhere over here. When you see this candle, you can enter somewhere here, put your stop loss above the 0.786 level. Again, all this has been spelled out in the other trading video on how to swing trade, how do you put your stop loss, how do you manage your take profit. All this good stuff is included in that video. So just make sure you check that out. I'll leave a link in the description as well, so you can click the description later to check out that video. So that is how you apply multiple time frame analysis into this swing trading strategy. You start with the higher time frame, you identify a key level, then you go into a lower time frame, which has to be at least a factor of 4. In this case, it's a H4. Then you look for either a trend line break or trend line bounce. After you do that, you want to draw your Fibonacci retracement and look at the 0.618 level or the 0.786 level. Okay, you want to see that there are multiple confluences between the trend line, the higher time frame support and resistance key levels, and market structure. That's what you want to be doing. So now I've come to the end of this video. I want to end off this video by sharing with you how we took the pound dollar trade that we sent in the morning, just a couple of hours ago for our premium subscribers. So let me just clear everything. So in this case, let's look at the daily. Okay, daily again. What do we see over here? We see that there is a form of support over here that price has broken. So our daily level is about 1.304458. So that's our level. Price has broken it, at least in the lower time frame. In the daily chart, it hasn't broken. So the daily chart is bearish. We want to be selling on the daily chart. So we drill down to the H4 because in the H4, we want to align the H4 with the daily. So you can see that in this case, the daily is also, sorry, the H4 is also very bearish. Okay, so H4 is also bearish. So we decide to drill down one more time. Okay, so after the H4, following the factor of 4 rule, we are going back into the H1. Okay, so H1 again, it's very bearish. So what you can see is you can actually just draw a trend line. It's not very easy to see in the H1, but what you can do is you can drill down even lower. And if you go into the next time frame, which is the M15 time frame, right? Factor of 4, remember, always remember factor of 4, and you just draw your trend line nicely. Okay, you can draw something like this. Then you can see that if you were to draw your Fibonacci retracement high to low, okay, it's here, and you just map out this level over here, 0.618 level, and the 0.786 level, then this is your level that price was resisted over here. And in fact, if you were to look left, let me just clear this up so it's clearer. If you were to look left over here, you can see that there is some form of market structure over here. And this upper level coincides with this spike low over here. So this is a good level. And what happens is that price broke this key support level that we plotted in the higher time frame. And in the lower time frame, price just retrace back up into our trend line. So our swing trading strategy is trend line, right? In this case, it's a trend line bounce. And then you look for a Fibonacci retracement. After the Fibonacci retracement, you want to look for market structure confluence at the same time. So in this case, this is how we executed this trade. We went from this daily time frame. Okay, let me just clear it. We went from this daily time frame, this line over here. Okay, it's a bit difficult to see. Let me see if I can just zoom it in. Okay, this is the line. Let me just change the color so it's clearer. This orange line. So in the daily, we identify this line as a crucial key support. Okay, so what happens is that price, when traded below, and in the lower time frame, it had a very nice setup, very nice pullback into the trend line, confluence, the market structure, and the Fibonacci retracement level. So that's how we actually entered this trade. Okay, so hopefully that is clear. It's a bit more advanced because we drilled from the daily chart, the H4, H1 to the M15. Okay, you do not need to drill down so many times, but to us, we just saw this opportunity. We thought it was a good trade, and that is why we entered this trade. So hopefully it's clear. If you have any questions, just leave a comment down below. Okay, just as a recap, where I started off this video explaining to you why you should be using multiple time frame analysis. Basically, allows you to have higher probability trades and capture big reward to risk trades. The second thing I went through was how do you select your time frame? How do you choose your time frame combination? You basically use the factor of 4. You do not want to choose anything below the factor of 4. So if you are using the H4 chart, you can use the daily chart as your higher time frame. You can use your H1 chart as the fine-tuning entry time frame, but always use a factor of 4. Then I went through the swing trading strategy step by step. Basically, you draw a trend line. You look for either a trend line bounce or a trend line break. After that, you draw your Fibonacci retracement. And then you look for a confluence between your Fibonacci retracement, trend line, and market structure. Then I went to the charts and show you how do you incorporate multiple time frame analysis into swing trading. Basically, you just add one additional step. You identify the key support and resistance level on the higher time frame. Then lastly, I showed you how we actually entered the pound dollar trade today. Now the trade is still running. We may not hit our take profit. We don't know. But this video is just meant to show you our thought process, how we do it. It's not meant to show you that it's a guaranteed thing. There's no such thing as guaranteed in Forex, in trading, right? You're always risking your money. There's always a risk that you lose your money. So please just try to understand the context of what we are doing here. And if you have any questions, just feel free to leave a comment down below. Okay, so if you have gotten value out of this video, please, hit the like button, hit the subscribe button. It will mean a lot to us. It will encourage us to create more videos like this to better serve you. Right, then do leave a comment down if you have any other questions. It doesn't have to be related to this topic. It can be any topic. We will record a video just to serve you, right? Even if you are just the only person asking these questions, because this is what we are here to do. We are here to serve you. So just let us know. Okay, if not, thanks for watching. I'll see you in the Telegram channel.